Well, tax credits is a very interesting subject. Not really, but so I thought I'd try to do some Phoenix history with it as well, just to kind of liven it up a little bit and not make it quite so dry. And also for anybody that doesn't really know the Phoenix history, we do have a long, interesting, strong history here in the community. We actually started in 1971. We were started by some members of the recovery community and some civic leaders that felt the need for residential treatment. It started out just being for alcohol treatment. It didn't start out with alcohol and drugs, just alcohol and just for men. So that was kind of the start of it. The property that it started was at 5th Street. Our 5th Street property was owned all the way up until 10 years ago. And that property is probably the most well-known property for Phoenix. It's our anchor property. Even now when we go out into the community and we talk about Phoenix programs, people reference Phoenix House and they picture that 5th Street property, which is actually no longer there. I think it's student housing now. But this was what the 5th Street property looked like. So in 1978, Phoenix became incorporated. 1974, Phoenix became incorporated. So that's when everything started becoming official. In 71, they had a board of directors, but in 74, they were a nonprofit corporation. So that's when they were able to, so then a few years after that, in 78, we started applying for grants, Department of Mental Health funding, and that's kind of when Phoenix really got its start and was able to really grow some programs and really start serving some people in the community. Here are some other properties. So the top two are 5th Street. This 7th Street location was a therapeutic community location that we also had. And then we rented space here on Vandiver, and that was our outpatient, and that's where our offices were. Individual and business donations in all different kinds of increments that went towards the facility, and then what was left we took out in a tax-exempt bond. And that was just kind of some of the progress when it was being built. And now we are at maximum capacity. We are taking over offices. We are adding beds in every single nook and cranny that we can. We recently this year added 10 beds, 4 of those beds being crisis beds, and we are still at maximum capacity. We're at maximum green space, so we cannot expand out. We can only take over the areas that we currently have or build up. We did ask actually if we could build up, Teresa and I did, and the look that we got was kind of like, probably not, it'd be pretty expensive. And just here's some other pictures. So we're going on the 10th year now in this facility, but I still call it the new facility because it still looks new and shiny to us that kind of knew what 5th Street was like before. But tax credits really kind of played a big part in building this facility. So our current mission to improve the health and quality of life of those impacted by drugs and alcohol. This is where we are today. Obviously, we've moved on from just doing the alcohol treatment. We've moved on from just serving men. We serve men and women in all of our services. That's detox, residential, and outpatient. We are a grassroots nonprofit organization here in town with just one location. And I'll go to some misconceptions later on, but we are just Phoenix. We are just our building, and we do have a big, beautiful building, but it takes a lot to keep this big, beautiful building going. And we have 55 staff and serve over 2,000 consumers each year, and our annual revenue is about $3.4 million, and it comes from about 22 different funding sources. Here's our funding. The majority comes from federal funding. Some of that is funneled through state, but it is actually federally sourced funding. And you can see that our donations is a very small percentage of that. Our local grants is a small percentage of that also. federal being the biggest, and then state being the second after that. So we definitely are, we are at risk if anything happens at the federal level or the state level. We definitely are at risk if we lose funding. So we just try to diversify our funding streams as much as we can. So some of the misconceptions: we are not Phoenix Home Health. We've had people show up for interviews here. We have had people call here thinking that they're calling Phoenix Home Health. I know at one time there was a big sign on Providence, so not too far from our building, so I think that kind of attributed to it as well. But we are not in any way, shape, or form associated with Phoenix Home Health. And we're not a multi-state for-profit corporation. We are at the table with lots of large health care providers. And I think sometimes the misconception is that we are a for-profit, we're multi-state, we have a huge corporation behind us, and we don't. Phoenix literally every day lives and dies by the decisions that the management makes and the board of directors make, and the reserves that we have. We don't have a big corporation behind us kind of backing us. And we're not a state agency. This was one that I heard a couple of weeks ago, that somebody actually thought that we were a state agency, so didn't kind of realize why we might be asking for certain things. Well, you're a state agency, how can you do that? We're not. We do get some funding from the state, but we have to follow the rules and regulations. That's a contract. If they want to reduce, revise, or take away that contract, they absolutely can. So now I'll kind of get into the tax credits a little bit. The agency that issues the tax credits is Missouri Housing Development Commission. And they started in 1969. And the tax credits that we're talking about are Ahap tax credits, and that's Affordable Housing Assistance Program tax credits. The Missouri Housing Development Commission provides other tax credits. They also are the umbrella over Missouri Housing Trust Fund, which provides grants in Missouri. But they are the commission that we apply to. So when we apply for tax credits, it's a competitive process. It's an application that's graded. If we miss something, we could not get funded for the tax credits. They come out and do a site visit. We actually have to be in compliance and have site visits for 10 years from that 1 year that we get issued tax credits. So it is a lengthy, strict process. But for people that are buying tax credits, it's good to know that we are regulated, that we have to do what we say we're doing, and you can really trust that your money is staying here in Columbia, in Boone County, and we're doing what we say we're doing with it. So the tax credits, well, first I'll say, so the goal of the tax credits was to, as is an initiative to have businesses donate to local nonprofits and to encourage affordable housing. So because of the services that we provide and having the residential facility and the housing components that we do, we qualify for that. And they really encourage that, and these tax credits are to promote that. And that's why they're doing it, the preservation of affordable housing. So to get actually into the details of the tax credit, the tax credit is a one-time tax credit, so you can only use it once. To an eligible donor, it qualifies for 55% off your state tax return. So you also get to count it as a federal charitable deduction. That's just your state portion that you get. That's what makes it so attractive. You can carry them forward for 10 years. So if you were to purchase tax credits this year, thinking, well, maybe I'm not sure if I'm going to use them, I don't know if I should purchase them, you've got 10 years. Now, if you get to the 10th year and you still haven't used them, you can transfer them to somebody else. They're fully transferable. So you never run the risk of actually losing that tax credit. Eligible donors, it's most almost all businesses, corporations, LLCs, anybody that just files a regular 1040 is not going to qualify for a tax credit. If you file a 1040 with the rental income schedule, you do qualify. But anybody that just has a W-2 and a 1040 would not qualify for these tax credits. There has to be a business tax return to qualify for the tax credits. And that would be if you're filing on a Form 1120, a sole proprietorship, a farm operation, rent or royalties income, small businesses, banks, credit institutions, insurance companies, S Corps and C Corps. So all that said, I know that's a lot of information. I thought I would do a breakdown of an example donation and kind of how that looks. So, there we go. So my example donation is on $10,000. And I thought I would just subtract everything and then come to the bottom line so you can actually see in dollars and cents what it equates to. So $10,000, you're going to get $5,500 off your state tax return right off the bat. And if you don't have that much in state tax liability, that's just going to carry forward. So you won't ever lose it. You get your federal charitable deduction. I used an example of 21%. This tax bracket, you would have to consult with your tax preparer on that. But this is probably an average of where most people are going to fall. So you're going to get $2,100 back on your federal tax return for making that $10,000 donation. Then in addition to the Missouri tax credit, you're going to get a Missouri charitable deduction of 6%. So you're going to get an additional $600 off your Missouri tax return. And that's just the difference between a tax credit versus a tax deduction. So that equates to $8,200 you're going to get on your tax return. So you've made the donation in April. You're going to file your tax return in January. You're going to get $8,200 of that $10,000 back. So really what you're out of pocket is $1,800. With that said, Rick and I spoke to somebody who actually brought something up to us that got us thinking a little bit further. If somebody has stocks that you want to donate, so eligible donations are cash, real estate, stocks, professional services. Stocks being one that I think could potentially be the most beneficial. If somebody has stocks that they have if they cash them out, they're going to have to realize a large capital gain on those. You could donate those stocks. You would donate them at the value that they are. You would not have to take the capital gain. You would still get all these tax deductions. So depending on what that capital gain could be, if you had a $5,000 stock and it's now $10,000 and you cashed it out, you would have to pay 15% on that $5,000 that you made money on. If you donate that $10,000 stock to us, you don't. You don't pay that 15% and you still get all these tax deductions. So the example here is probably a more conservative example, depending on your individual tax bracket, tax situation. You could really utilize these credits to relieve some tax liability. A couple of things that I'd heard from some people that have donated for tax credits before or are interested is they've run into the issue of they're going to pay the federal government, or they can go through this route and keep the money here in their community, serving people that with an agency that we know we're doing what we say we're doing, rather than sending that check to the IRS. And most people, given the choice, would prefer to do that. It doesn't in any way, shape, or form take away from donating. You know, sometimes I think if we go on and on about the tax credits, I definitely don't want to take away from the philanthropy piece of that. But it is just an added bonus, and you know, Missouri does this to encourage people to donate back into their community. and to preserve affordable housing and to do these things. There are other tax credits out there. There's neighborhood assistance tax credits, there's youth tax credits. Most of those are at 50%. So ours being at 55%, we've been told before that we kind of have the best tax credits, because that extra 5% can be quite lucrative. Donations must be made to an eligible nonprofit. Of course, Phoenix is an eligible nonprofit. That's why we're talking about this. The current tax credits that we do have, they do expire April 30th. So anybody that this round would be interested in donating or getting the information out to somebody else that's interested in donating, the donation would have to be made by April 30th. We are in the process of applying for the second round. So if we get those, they would expire June 30th. There's usually multiple rounds throughout the year of Ahap tax credits. Kind of gives donors an opportunity to donate throughout the year. Because a lot of times by April 30th, you may not know your tax situation, so you may kind of wait until the second tier of that. So when we apply, we actually have to be specific about what we're going to use the money for. We can't just apply and say Phoenix is going to use it as we please. So we specifically wrote this for staffing the residential facility. So the residential facility is 24 hours a day. We have 3 staff round the clock that are taking care of our residential facility. There's other staff too, but actually on the floor taking care of the clients. And the fees that we get from DMH to run our residential facility is about $24 per person per night. And that does not cover round the clock monitoring, food we have to feed, 3 meals a day. That does not cover that. So we wrote this particular tax credit application to fill that gap. And what happens if we don't get these donations is we have to start, we would have to look at restricting our residential facility, because we wouldn't be able to afford to keep that open, or keep it open to the extent that it is now. And just to put that into a little bit of perspective, we have a 3-month waiting list. So the need is definitely there. So any donations for these Ahap tax credits goes directly to staff that are treating the clients. There's just the forms to fill out. There's one form to fill out, has to be notarized. We have a notary. We can make the paperwork really, really easy. You can come in and we can go through line by line, and a copy of the council check or stocks or real estate, whatever it is that's being donated. So the paperwork is not cumbersome, but these tax credits are a way that somebody that's already wanting to participate in the community and donate, it's a way that it's not such a huge financial burden.